Okay, so the authors here are going to examine three different methods of determining the momentum for mutual fund portfolios. Right here we have the descriptive statistics for the mutual funds that are under examination here, and these existed between January 1970 and December of 2004. And as you can imagine, as time went on, there were more and more mutual funds, as well as more and more net asset values of those mutual funds. But we can see here the net asset size of the funds, the 25th percentile and 27th. So you can see the range of sizes here in the standard deviation. And you can also see the average fund has about 80% turnover, 1.12 expense ratio, about 1% monthly return, so on and so forth. They're also examining the no-load funds, and they want to do that because they want to try to look at the momentum returns on a more practical investment basis with less transaction costs. You would generally be unable to perform some of these momentum strategies under the load funds because it would be too expensive. So they're adding another subset of no load funds here. And they've got about the same characteristics as all of the funds. They just tend to be a little smaller on average. Okay, so here in Table 2, they've started to analyze the mutual funds for different types of momentum sources. So what we have here is the authors have ranked all of the stocks in three different ways, not stocks, mutual funds, in three different ways to assess the returns. So the three different ways are the prior 6-month returns, and this is more in line with the Jagadish and Titman method from 1993. They've also ranked them according to the factor loading in the Fama-French-Carhart model, and they've also ranked them according to the nearness to the recent 52-week high. And so then the top or bottom decile from each of these ways of sorting are put into equal weighted portfolios and held for the next 3, 6, or 12-month period. So the ones that are in the top decile, we can say that we can think about as we're holding them long, and then the ones that are in the bottom decile, we would be shorting, and the difference would be the zero cost portfolio here. We've also got some T statistics here, and it looks like all of them are significant except a few of them in the momentum factor loading sections, 0.85 and 0.97 and the 0.94. So it looks like at least for the momentum factor loading, we really can't say that these are significant from zero. But at first glance, we can see that the prior 6-month returns method, Jagadish and Titman method, does end up with the highest difference between the top decile and the bottom decile. And by holding this portfolio for 12 months, we get 0.48% per month excess return of the top decile over the bottom decile. And it looks like using the nearness to the 52-week high does give us some pretty significant excess returns of the top minus the bottom, but not quite as high as the prior 6-month return. But even though the momentum factor loading didn't give us statistically significant excess returns here, down at the bottom we do have significant returns when we look at the alphas of the Fama-French model, so we'll discuss that in a second. And so in this panel B section, we're doing the same thing, the same methodology for ranking and holding but we're putting these returns into the Fama-French three-factor model. So those three factors being the market return, the size, and the value growth. So these are all the alphas after controlling for those factors. And we can see in all cases the top portfolio, the one that we're holding long, is a positive return, or rather a positive alpha, and the difference here is fairly big and fairly significant. So we could think about this as this is the excess returns that can't be explained by the company's size, value or growth, or the market return. And so next here in table 3, the author's done the same thing as table 2, the previous table, only this time we're looking at the top 30 at top and bottom 30% of these rankings rather than the top and bottom 10%. So this gives us a wider range here. And so the first thing to see is now that we've moved away from the extreme cases, only getting the top and bottom 10%, to less extreme cases of these momentum sorting methods using 30% of the top and bottom. These differences and the returns are a bit less here, as we would expect, than the ones from table 2. But having said that, we still have some pretty high significant excess returns of the prior 6-month return method and the prior 52-week high method, where over a 12-month period we can get excess returns of 0.31% or 0.18% per month. And so looking at the risk-adjusted returns here, these are, if you remember, these are the alphas from the three-factor model. Just like we saw in table 2, all of these methods produced excess differences of returns from the top and bottom 30%. However, the momentum factor loading at the 12-month horizon is not statistically significant. This T statistic is not high enough. So next, the authors have summarized graphically in this figure 1 the excess returns of being long the top 10% for each of the ranking methods and being short the each of the ranking methods and the difference between those two. And so this JT, the Jagadish and Titman past 6-month return here. Then we have the nearness to the recent 52-week high, and then this is the factor loading on the beta 4, which is the loading on the momentum factor in the Carhart 4-factor model. And then these are the returns over the next 12 months, or for holding over the next 12 months. Right here we have we're ranking or holding the top or bottom 10% for each of these, and here we're holding the top or bottom 30% of these. So we see initially that these returns are a lot higher than these, and that's what we found in the prior tables, because we're moving from holding only the extreme to a little less extreme in the momentum rankings. And so first we see here that the Jagadish-Titman past 6-month formation period strategy is clearly dominant, provides the highest excess returns in both the 10% and the 30% strategy. The 52-week high strategy starts out pretty good, but ends up dissipating by the 12th month. And the factor loading strategy here is really small excess returns, but is fairly consistent over the entire 12 months. And these are all things that we saw in the prior two tables, but it's easier to see graphically here. And so next we have figure 2, and this figure basically summarizes in graphic form the prior two tables in the B section. So these are the alphas after regressing the returns of these strategies and hedging out the Fama-French three-factor models, or factors. So these are the alphas of the returns after controlling for the size, market, and value growth factors. And so similar to what we saw in the tables, here the Jagadish and Titman strategy and the 52-week high strategies dominate according to alphas, but kind of start to dissipate by the end of the 12 months. And interestingly, the factor loading strategy remains pretty consistent throughout all the 12 months and actually finishes stronger than the other two strategies. And this is only when looking at purely at the alphas of the strategies, not necessarily the raw returns as we saw in the prior figure. Okay, so next we have table 4 here, and what the authors are going to do is do a Fama-McBath analysis of these three different momentum ranking strategies. And first here we see panel A is where they're going to use the top and bottom 10%. Panel B is going to use the top and bottom 30%, as we've seen in the prior tables and figures. And now here we see we've got JT, which is the Jagadish and Titman, the past 6-month return strategy. We've got the Beta 4 strategy, which is the momentum factor loading, and then the 1 year, which is the one where they're ranking by nearness to the 52-week high. This sort of make this table a little bit difficult to read, but we have these three strategies with for the winner, the top 10%, we have these three strategies with the loser, it's the bottom 10%, according to these rankings. And then we have the winner minus the loser here. So what they're trying to do in the Fama-McBath analysis is regress the returns of these and see what is the actual contribution of each of these different strategies to the total return when controlling for the others. So we're trying to isolate the effect of each of these strategies on the total return. And so first off, well, we have the raw returns here with holding periods of 3, 6, or 12 months, and then risk-adjusted returns 3, 6, and 12 months. So first looking at the JT, going along the top 10% of the ones that with the highest past 6-month returns, we see those are all significantly positive with significant T statistics across all holding periods. Also, we see that the bottom 10% rankings also have negative returns, so going short these, this portfolio would result in positive returns. And also the JT winners minus loser is a significant amount here with significant T statistic. However, the momentum factor loading strategy does not result in significant returns. As we see, the T statistics are well below 2. The loser portfolio is also not significant, so the difference between the two is not significant. So looking at the 52-week high strategy, we see they're somewhat profitable the difference between the top 10% and the bottom 10% is positive, but not very significant. Certainly we see the Jagadish-Titman strategy is double that of the 52-week high strategy. Moving to the risk-adjusted returns, we see that the T statistics are all significant, except maybe this one here for the 1-year loser 52-week high strategy. So these are all statistically significant results. But as we've seen in the couple other tables and figures in this paper, the momentum factor loading comes out pretty good when looking at the risk-adjusted returns here. And you remember these are the alphas from the Fama-French three-factor model. So down here in panel B, we're doing the same analysis as up here, but we're using 30% of the top and bottom portfolios rather than 10%. And so, as what we've seen in the prior tables and figures, the returns to the 30% are a bit lower than the returns in the 10% just because we're using less of an extreme case. As we've seen before, the Jagadish-Titman strategy far exceeds the others, although it's a bit less than the returns from the 10%. They're still statistically significant. So here the winner minus the loser, get an extra excess 0.31 instead of 0.7. And as we saw in the 10% case, the JT long strategy gets us positively significant returns, as does the 52-week strategy. But the momentum factor loading strategy does not give us significant results here on the long side. On the risk-adjusted returns, we see here the T statistics are all fairly significant. So we could say these results are likely not zero. But as we found in the panel A, within panel B, we see that these are all profitable results at all holding periods. So looking at the 6-month risk-adjusted return only, the return for each of the 3 strategies is 0.18 per month, 0.12% per month, 0.07% per month for each of these respectively. So these are pretty significant alphas here after controlling for the market size and value growth factors. So next the authors take, here in figure 3, take the results from the table 4 that we just looked at and put them in a graphical form to show the different hedged alphas over the 1 to 12 month holding period. And here we got the top and bottom, or the top 10% of the portfolio and the top 30% of the portfolio. So looking at the 10% here, the first thing we see is that the Jagadish-Titman strategy overtakes the others initially, but they all seem to kind of converge at the 9-month period. The factor loading strategy, here the beta 4, seems to be the lowest return initially, but soon overtakes the others by the 12th month and is generally the most consistent one over any holding period. Okay, so next the authors decided to extend their analysis out to 24 months instead of just 12, which is what we've seen in the prior tables and figures, and this is here at figure 4. Panel A here is the alphas when regressing each of these 3 strategies on the Fama-French 3 factors. Panel B is the hedged alphas where they've hedged out the effects of the other strategies on each strategy, so we're getting the pure alphas. And so in both tables here, we see that the strategy of ranking by momentum factor loading continues to be positive and consistent on through the 24 months, but the other two strategies seem to go close to zero. So the authors suggest that using the strategy of the ranking by momentum factor loading might give the portfolio less transitory momentum effects of its holdings, because the strategy seems to be more consistent over longer periods of time than the other two, which seem to be fleeting. So an investor who doesn't necessarily want to rebalance their portfolio, but once every 1 or 2 years, might be better served having their ranking system be on momentum factor loading. Okay, since we found that in order to implement these strategies, we would need to rebalance every 6 to 24 months or so. So to make that a practical possibility, we would have to reduce fees, and to do that, we would want to invest in no-load funds. So the authors here have isolated the effects of each of these strategies on no-load funds only, and that's here at Table 5, the results of using the top and bottom 10% strategy. And we see here that these returns for each of the strategies is still large and statistically significant, and pretty much in line with the overall mutual fund population that we saw in the first few tables of this paper. And here we have Table 6 with the no-load funds only, with 30% of the top and bottom. And these returns are also significant and positive, and pretty much in line with the same table that we saw earlier in the paper for all of the funds. And then here at Table 7, we have the Fama-Macbeth regressions results. And so we see that these are all positive and statistically significant for the winner minus loser. We also see that the ranking of factor loading is not as significant until we get to the 12-month period. And these results are similar to the results we found for all of the funds. So next, here in Table 8, the authors decided to explore the reasons for cash flows into and out of these mutual funds. And to do so, they regressed each of the strategies. They regressed the cash flow on those three strategies. So the lagged 6-month return, the momentum factor loading, and the nearness to the 52-week high. And so we see here that the past 6-month return of the mutual fund is a good predictor of cash flows into the fund from investors, and also the nearness to the 52-week high, because we have significant T statistics here for each of these. However, the momentum factor loading is not a significant predictor of cash flows. And we also see that these lagged 6-month return and nearness 52-week high are still significant after we control for the size of the fund as well as the previous month's cash flow. And then getting over here to all of the factors here, turnover expense ratio, and the maximum total load do not explain the cash flows significantly. However, we see that the previous month's cash flows, size, the nearness to the 52-week high, and the lagged 6-month return are all good predictors of the cash flow. But the momentum loading is not. However, we've seen in the prior tables that it's a good source of longer term, more stable alpha, whereas these other momentum factors are more transitory, short term sources of return.